Let's take a closer look at this. Imagine two different lives beginning at the same point with the same resources and opportunities. In early 2024, Marcus and Sofia are both 30 years old and work as software engineers in Austin, Texas. They each make $120,000 a year, so they are in the same tax bracket. They each have saved exactly $50,000 of investable cash, after taxes and living cost. They live in similar apartments in the same neighborhood, pay similar rent. They have the exact same ambition to build long-term financial independence so they can eventually own their time. But in January of 2024, their paths diverge over one financial decision. Marcus believes passive index fund investing is too slow, too boring, and he has the analytical skills to outperform the average market return. His programming background, mathematical training, and disciplined approach make him think he can trade technology stocks and short-term options for active income. He opens an active margin trading account with a popular retail brokerage, downloads a professional charting platform that cost him $200, and pays $2,000 for an online day trading course. He also subscribes to a private Discord chat room run by a popular trading personality for $250 a month to receive real-time buy and sell alerts. Marcus spends his mornings before work studying candlestick patterns, drawing support and resistance lines, and studying moving averages. Sofia chooses to go the opposite way. She doesn't want to spend her free time looking at charts, reading earnings reports, or thinking about the stock market. She opens a brokerage account, puts in her $50,000, and buys a cheap, passive index fund that tracks the 500 biggest American companies. She makes arrangements for an automatic transfer of $500 from each paycheck to buy more shares of the same fund, deletes the brokerage app from her phone to prevent temptation, and gets back to focusing on her career, her health, and her hobbies. The next 2 years will see a dramatic divergence in their day-to-day lives. Marcus is mentally and emotionally exhausted all the time. He rises at 6 a.m. to check out pre-market futures, trades during his lunch break, and stays up late poring over his wins and losses. And when a trade goes his way, he gets a massive surge of dopamine and thinks he has finally cracked the code, and that he is about to quit his job. But when a trade goes against him, he gets very anxious, and often revenge trades with larger position sizes to try and recover his losses before the market closes. He's constantly distracted at work meetings, checking stock price feeds under his desk, and his sleep begins to suffer. He's always checking his phone, which strains his relationships and hurts his performance at his day job. Sofia ignores the stock market for those same 2 years. When the headlines scream about inflation on the rise, recessions coming, or geopolitical tension, she doesn't read them. When the market falls, she does not panic. She does not even know it is happening. Every month, on autopilot, she buys more shares with her automatic contributions. In her spare time, she is learning new programming languages, working towards a promotion at work, and traveling with friends. She is present in her relationships and sleeps well at night. By January of 2026, 24 months will have passed. The gulf between them is vast. Marcus sat in front of his monitors, tired and defeated. His active trading account balance is zero. He's lost all the $50,000 of starting capital, and another $10,000 that he moved from his savings to meet margin calls. He has spent over 1,500 hours staring at charts, lost sleep, and hurt his career performance. Sofia is at ease. Her index fund has been quietly compounding in the background. Her initial $50,000, plus her automatic monthly contributions, ballooned to over $70,000. She has not spent 1 hour looking at charts, and has not felt 1 ounce of stress. To see why this is, we need to look at the math of active trading that the gurus and platforms never tell you. It was not that Marcus was stupid or lazy that he lost his money. And he lost it because the math of the system is systematically stacked against the active retail trader. Now let us see the particular leakages that drained his $50,000. First of all, there are the visible costs. Marcus paid $2,000 up front for his educational course, and $250 monthly for his trading Discord subscription. That chat room subscription cost him $6,000 for 2 years. That means he was $8,000 in the red before he made a single trade. This is capital withdrawn from his compounding engine and given to those who sell the illusion of trading success. The second is the silent drag of slippage and bid-ask spreads. Whenever Marcus wants to buy a stock or an option, he has to buy it at the ask price, which is slightly higher than the market value. Every time he sells, he has to sell at the bid price, which is slightly lower. For volatile stocks and near-term options, this spread averages about 0.2% of the transaction value. Because Marcus is actively trading, he is averaging 5 trades a day with an average position size of $10,000. So that means he's doing $50,000 worth of volume every single day. A 0.2% spread drag on $50,000 of daily volume is $100 a day in invisible costs. This means that over the course of the year, 250 trading days, Marcus is losing $25,000 to the bid-ask spread and execution slippage. This silent friction is constantly eating away at his account balance, even on a commission-free brokerage. Thirdly, there is the devastating impact of the wash sale rule under U.S. tax law. Marcus didn't know that the tax system treats active traders differently than passive investors. In his first year, Marcus had a lot of wins and a lot of losses. He made $50,000 on profitable trades, but he also lost $40,000 on losing trades in the same popular tech stock. He supposed that he would only be taxed on his net profit of $10,000. But because Marcus bought back the same stock within 30 days after selling it at a loss, the Internal Revenue Service disallowed his $40,000 in losses. He had to pay tax on the entire $50,000 of capital gains at his ordinary income tax rate of 24%. That meant he had to pay $12,000 in taxes on a net profit of $10,000. With his remaining trading capital, Marcus had to pay the tax bill, and it hastened the collapse of his account. The mathematics of leverage and options contracts, along with taxes and spreads, destroyed Marcus. To accelerate his account growth, Marcus started to buy short-term calls and puts. Options are derivative contracts that contain built-in expiration dates. This means that when you buy an option, you're betting on not just the direction of the stock, but the clock too. The contract loses value every day the stock does not move due to time decay. If the stock does not reach the strike price before the expiration date, the option expires worthless, and the 100% capital invested is lost. Academic research on options exchanges shows that more than 80% of options bought by retail investors expire worthless. Worse yet, Marcus used margin, which is money borrowed from the broker at an annual interest rate of 10%. His broker, seeing that the stocks he owned had declined in value, made a margin call, and he had to sell everything he owned at the absolute bottom of the market to pay off the loan. While Sofia was working in a friction-free environment, Marcus was working in these headwinds. Her low-fee index fund charged an expense ratio of 0.03%, so she was paying only $15 a year in management fees on her $50,000. Because she sold no shares, she triggered no capital gains taxes. And she only made one purchase, so there were no courses to buy, no chat room subscriptions, no bid-ask spread drag. All her money was still invested, and it was still compounding, frictionlessly. The result of this comparison was not accidental. It was a statistical certainty, predicted by decades of academic research. Wall Street spends billions of dollars promoting the idea that anyone with a laptop and internet connection can become a profitable day trader. The data, however, tells a different story. A landmark study published in 2013 analyzed the trading records of more than 300,000 individual day traders over a 15-year period. The professors who conducted the study, Brad Barber, Yitsung Lee, Eugene Liu, and Terence O'Dean, found the failure rate to be overwhelming. The researchers found that over 99% of active day traders lose money over the long run. Once you factor in transaction costs and fees, only a tiny fraction of 1% remain consistently profitable. The study revealed that most day traders are not investors, they are just transferring their wealth to institutional market makers and brokerage platforms. This pattern is consistent across countries and asset classes. In 2020, finance professors Fernando Chegue, Rodrigo de los Soales, and Bruno Giovanetti followed 19,646 individual day traders trading equity futures for over 300 days. The results were even starker. The researchers found that 97% of all day traders lost money. 1.1% of people earned above the national minimum wage, and only 0.4% of people earned above $54 a day after costs. The study found that for a single retail trader, developing a sustainable and profitable edge against institutional algos is virtually impossible. To add further empirical weight, a 2018 study by the Financial Industry Regulatory Authority examined the financial literacy and behavioral attributes of active retail traders. The researchers found a shocking paradox. People who traded often did much worse on basic financial concepts like compound interest, inflation, and tax optimization than passive investors who didn't trade. The study showed that day traders are often motivated by a sense of overconfidence and an illusion of control, confusing random market movements with their own skill. This behavioral bias leads to excessive trading volume and poor long-term financial performance. Growth of gamified trading apps has resulted in a significant increase in retail trading volume, but a decrease in average account performance, according to a 2024 report from the Securities and Exchange Commission. These apps have incorporated design elements from social media and online gambling to promote frequent emotional trading, effectively transferring wealth from the user to the platform operator through payment for order flow, the report noted. The solution to this trap is not to find a better trading strategy, pay for a more expensive course, or join a different chat room. The answer is to leave the active trading floor altogether and adopt the boring index fund approach. The core of real wealth creation is simple, automatic, and completely removes the need for active decision-making. The passive compounding system is made of 3 specific rules that remove human emotion and behavioral errors from the equation. The first rule is automatic payroll deductions. You have to make sure your investment contributions come out of your paycheck before the money ever hits your checking account. If you wait until the end of the month to invest whatever is left, you'll find that there is nothing left. Spending often rises to meet whatever funds we have available, a phenomenon known as Parkinson's Law. So when you get paid, the transfer is automated. Now you have to adjust the rest of your lifestyle to the remaining balance. You don't need to have daily willpower about your finances. Second rule is to buy the entire market with just one cheap index fund. Instead of trying to figure out which one company will be the winner of the future, you buy a little piece of the 500 biggest, most profitable companies in the United States. If you buy an index fund, like the S&P 500 exchange-traded fund from Vanguard, you instantly own a piece of Apple, Microsoft, Amazon, Nvidia, and Berkshire Hathaway. As these companies hire talented workers, create new technologies, and make billions in profits, your wealth grows with them. You don't need to dig into their balance sheets or read their earnings reports. The index does that for you automatically with the allocation. This index strategy has one large advantage in that it self-cleanses. The S&P 500 index is never still. If a company starts to fail, its market value drops and it gets kicked out of the index eventually and a new fast-growing business takes its place. This means your portfolio automatically throws out the losers and adds the winners without you having to make one single active decision or pay a transaction fee. The index does the work of filtering out failing businesses and reallocating your money to successful ones quietly in the background. The third rule is to absolutely refuse to respond to financial news. The active trader views market volatility as a threat or an opportunity that can be timed. The passive investor thinks volatility is irrelevant entirely. The market drops 10 or 20% in a downturn, but the automatic payroll contributions keep buying shares at a discount. You don't check your balance, you don't read the market predictions, you don't watch financial television. The less you interfere with your investments, the better they perform. Let's analyze the math behind this boring strategy over time, assuming a historical average annual return of 9%, which is consistent with the long-term performance of the American stock market. Let's look at the exact numbers in Sofia's portfolio. She automates a monthly contribution of $500 with $50,000. So in year 1, her $50,000 grows, along with her monthly contributions of $6,000. At 9%, she ends year 1 at about $59,405. In year 2, the interest begins to compound on interest. With another $6,000 in contributions, her portfolio climbs to about $69,657. By the third year, the compounding effect kicks in. Her account balance totals approximately $80,803. Capital base is growing year over year 4. She makes about $93,016. So she has contributed a total of $3,000 by year 5. But her portfolio is now worth about $106,288. Now the growth is outproducing her contributions. 10 years later, she has contributed $60,000, and her account value is approximately $194,142. She has more money in the growth part of her account than she ever put in from her paycheck. By year 15, her portfolio value rises to approximately $329,894. When you're 20, compound interest starts to work its magic. Her total out-of-pocket contributions over those 20 years were only $120,000, but her balance is about $539,188. She passes the milestone of $864,754 at the end of year 25. When she is 30 years old, her portfolio is worth about $1,378,991, from which she has only put in $180,000 of her own money. The compounding math of the index fund itself accounted for over $1 million of her net worth. Sofia has her accounts and automation set up in less than an hour total. She never misses a night's sleep, never checks a price chart in the middle of a work meeting, and never has to deal with the anxiety of a losing trade. Nor need we rely on theoretical models to demonstrate that this humdrum system is the best route to wealth for ordinary people. We can study the real lives of ordinary people who paid no attention to the noise of active trading and built up millions through simple, patient investing. Consider the tale of Ronald Read. He was a janitor and a Vermont gas station attendant. All his life he was paid a modest salary, never more than a typical working-class wage. He didn't trade options, he didn't day trade, he didn't watch the financial news. Instead, he bought shares of quality dividend-paying companies and held them for decades. He died in 2014, aged 92, leaving an estate worth $8 million, the vast majority of which was left to his local library and hospital. The financial media was apoplectic, but the math was simple. He began early, he kept his shares, he left compound interest work for him for 50 years without interference. And then there is the story of Earl Crawley, a parking lot attendant in Baltimore who never made more than $12 an hour in his life. He had a family, a mortgage, and he managed to save small sums week after week. He didn't chase high-risk trades or try to time the market. He just bought shares in index funds and good companies and kept reinvesting the dividends year after year. When he retired, he had over $500,000 in his portfolio, which he used to fund his retirement and help others in his community start their own investing journeys. And then there is Grace Groner. She bought 3 shares of a company called Abbott Laboratories for a total of $180 in 1935. She never sold those shares, and she never bought any other stocks. Instead, she programmed her account to automatically reinvest every dividend payout into more shares of the same company. When she died in 2010, her original investment of $180 had grown into an estate of $7.2 million. These everyday millionaires didn't have inside information or high tech. What they had was so much more valuable: patience, consistency, and the discipline to let the market do the work. They found out that the best investor is not the one who makes the most trades, but the one who makes the fewest changes. The math and academic data supporting passive investing is so overwhelming, it makes you wonder why so many men continue to fall into the day trading trap. The answer is found in the structural incentives of the financial system and the psychological conditioning of male consumer culture. Secondly, the entire financial system is set up to charge fees to people who are active in it. Brokerages, trading platforms, financial media outlets, and online gurus don't make money when you buy an index fund and hold it for 30 years. You trade, they make money. Each transaction generates revenue from things like payment for order flow, margin interest, software subscriptions, or advertising views. The financial media is about traffic and ad revenue, so they always create a sense of urgency warning about imminent market crashes or breakout stocks. Online gurus sell their courses and chat room memberships by showing off their fancy cars and expensive watches. It makes for a better story and a better sales pitch if you construct the false narrative that financial freedom is a fast, exciting game. To understand why brokerages offer free commissions, we need to understand the payment for order flow model. When you place a market order on a retail trading app, your brokerage does not send your order directly to the public exchange. Instead, they aggregate your order with thousands of others and sell that flow to high-frequency market-making firms. The market maker executes the trade, makes a tiny fraction of a cent per share on the spread, and sends a portion of that profit to the brokerage. That is, as a retail trader, you are not the customer of the brokerage, you are the product. It is your trading data that is being sold. The brokerage makes money on every trade, so their whole business model is based on keeping you engaged and trading as much as possible. This leads to a fundamental misalignment of incentives. The platform wants you to trade all the time. Your financial success demands you to buy once and hold for decades. Second, modern trading platforms are built on the same principles of behavioral psychology as casino slot machines. The bright green and red color schemes, the flashing notifications, the digital confetti when a trade is made, and the simplified interface all work to reduce your perception of risk and to trigger dopamine releases. When you make a successful trade, you get a dopamine rush in your brain that makes you feel powerful and intelligent. If you lose, the platform makes it so easy to place another trade straight away to try to win back your losses, which is a behavior known as revenge trading. This sort of gamification makes active trading an interactive entertainment, not a disciplined investment strategy. Third, active trading has a powerful masculinity trap built in. Men are culturally programmed to think about financial success in terms of competition, aggression, complex strategy, and risk-taking. We are told that building wealth is about beating the competition, finding the hidden loophole, trading a lot. Quiet, dull consistency is presented as passive or weak, and active trading is presented as strong, smart. This cognitive bias makes men particularly susceptible to the day trading traps, because they feel that passive indexing is losing control, rather than seeing that it is the most mathematically sound wealth-building tool ever invented. If you want to escape this trap and create true and lasting financial security, you need to take control of your financial infrastructure and put it on the right defaults. Here's a step-by-step progression from active trading to passive compounding. The first step is to cut the noise. Remove any active trading apps on your phone and computer. Cancel your subscriptions to charting software, your Discord chat room memberships, your active trading newsletters. Unfollow social media accounts that are pushing short-term stock trading or options alerts, and stop watching financial news channels. There is a constant movement of opinions and prices, and it's meant to get you emotionally involved. By taking away these inputs, you will instantly regain your mental clarity and protect your capital from impulsive decisions. The second step is to open a brokerage account with a reputable, low-cost custodian firm that specializes in long-term index investing. Fidelity, Vanguard, and Charles Schwab are all great choices, and they all offer zero-commission trading on index funds and exchange-traded funds, and very low expense ratios. It takes less than 15 minutes to set up an account online and requires no special expertise. Step 3. Choose one broad market index fund to be your core investment. If you are using Fidelity, then you can choose their 500 index fund, ticker symbol FXAIX. If you are using Vanguard, then you can choose their S&P 500 exchange-traded fund, ticker symbol VOO. If you are using Charles Schwab, then you can choose their S&P 500 index fund, ticker symbol SWPPX. These funds have annual fees of less than 0.03%, which means that your management costs will be next to nothing. Step 4. Make your contributions automatic. Set up an automatic recurring transfer from your checking account to your brokerage account the day your paycheck hits. Set up the brokerage platform so that as soon as those funds arrive, they are automatically invested in your chosen index fund. This automation takes away the monthly decision-making and makes sure you are investing consistently no matter what the market is doing, up or down. Step 5. Define your role. Your job is not to manage the money. Your job is to let the money manage itself. Put a reminder on your calendar to sign into your brokerage account just once a year on January 1st. You only need to log in once a year to see how much you've contributed. Increase your contribution if your income has increased, and download your tax documents. The other 364 days of the year, don't check your balance. Close the app on your phone and let the mathematics of compound interest work quietly in the background while you work on your life, your career, and your relationships. They both started their journeys from the exact same spot, Marcus and Sofia. They had similar education, similar jobs, similar salaries, and similar starting savings. It wasn't intelligence or discipline or luck that made them turn out different. It happened because of their ties to the financial system. Marcus tried to fight the market, thinking he could outtrade institutional algorithms and escape the silent friction of fees, taxes, and spreads. He viewed investing as a sport that demanded participation, and the system rewarded his participation by sucking the capital out of him until there was nothing left. Sofia knew that the default settings of the financial system were set up to benefit the institutions, not the individual. She ignored the noise, automated her contributions, bought the entire market, and let the mathematical curve of compound interest do its thing. The financial industry wants you to be Marcus. They want you to trade, borrow, subscribe, panic, because your activity is their revenue. But to be financially free, you have to be Sofia. Getting everything in place takes less than an hour of dedicated effort. And the result is decades of quiet security, growing compound interest, and eventually the ability to own your own time. Math has no opinion and does not play favorites. The only question is when you decide to let it work for you.